Is this, I mean, that's what it looks like from a market perspective, looks like a good news, bad news situation on the assumption that the Fed is now going to have to raise and move faster? Is that the idea?
Yeah, the strong jobs number does raise the risk that the Fed becomes even more hawkish. So there's three things that we're watching to determine that. That's yields, earnings, and what is the Fed going to do? From a yield point of view, we actually think they've moved too far too fast. The magnitude of the move in January likely doesn't continue to that degree. We see them drifting moderately higher this year, though. Looking at the Fed, part of the reaction of yields is because the Fed pivoted to such a hawkish stance late last year. But if you step back, bigger picture, in the early cycle of rate hikes, actually that tends to be bullish for equities because you do have that earnings and economics growth that'll overshadow the rate hikes. And looking at earnings, the key to focus on is who's going to beat earnings this year. That's going to be driven by pricing power. You need to find those companies that can raise prices and beat these higher inflation trends. We're already seeing that just in the fourth quarter. We're seeing about 4% earnings surprises. Less of that is coming from margins. More of that is coming from revenues and pricing. We can't rely on margins going forward because of cost pressures. Look for pricing power. Great example of that today, of course, is Amazon, which raises Prime membership prices. Their ability to do that gives them the power.
That's what I was going to ask you, because this week, it's funny. We sort of stopped focusing on the Fed this week on the assumption that we were starting to look at earnings. And then we went on this roller coaster ride because you had Facebook on Wednesday that just took everything down with it. And then, of course, we now had Amazon on the other end of it. So which is it?
Well, this is to do with looking at who are the winners and losers in megacap technology. This is not the death of technology, even though some of these macro forces are headwinds to them. Looking at Facebook, social media is becoming much more competitive. We saw Alphabet talk about that this week with YouTube. But the companies that dominate their spaces, like Amazon, putting up their strong numbers, Alphabet with their strong advertising spend and market revenues and market share gains, these companies that can dominate with these structural growth trends can continue to maintain their multiples going forward. And it has to do with who can beat earnings. Looking at Facebook, they're actually going to have probably more issues going forward because of their targeted advertising businesses, competition from TikTok going forward. That's going to be an issue. And if you can't put up the earnings this year, it's going to be hard for your stock price to work because that is basically the last lever you have to pull.
Right, but part of the issue has been effectively a re-rating in terms of what the multiples that are being applied to big tech, and whether you think that they hold up or that they actually continue the downward slide, given what you think is happening with the Federal Reserve and now the impact of the jobs report.
Yeah, I mean, the macro overhang is going to be a headwind for valuations for tech overall, but those companies look at front office software that are tied to client revenues. Again, you have to tie yourself to pricing or revenues for your clients or for your own business. These companies should be able to maintain their ratings. Amazon, interesting, though, how much it's up in the aftermarket. It's still barely retracing what it's lost year to date. It still has a good valuation in terms of its ability to expand going forward. But you do need to be more selective. It's going to be about winners and losers in technology, not like we've seen in the past where all boats rise in the mega cap space.
Shepard Smith here. Thanks for watching CNBC on YouTube.